afternoon. My name is Jose Martinez and I'm a mortgage lender with U.S. Bank, and I'm here to talk about why mortgage interest rates are as low as they are now when many industry experts expected them to be a lot higher. I'd like to thank Luxury Valley Homes, one of our partners, for giving me the opportunity to speak with you today. Now, before I start talking about why rates are as low as they are, I think it's really important that you understand how mortgage rates are impacted and what causes them to go up and down. To begin with, a lot of people believe that mortgage rates are actually based off the 10-year Treasury note, and that is absolutely not true. Mortgage rates are directly impacted by mortgage-backed securities, which are a form of a bond that are sold out in our bond market. Now, to understand why mortgage rates go up and down, you have to understand the dynamic that exists between the stock market and the bond market. Okay? Whenever there is a good day that's going up in the stock market, people obviously investors will pull their money out of the safe haven of bonds and put it into the stock market to capture the gains of that day. Now what happens is there's less money being put in bonds, so what traders have to do is increase yields in order to attract more investors to come in. So by increasing yields, they have to increase rates, and such mortgage-backed securities or types of bonds, we're going to see interest rates on mortgages also go up. Now, on the contrast, if there is a day where the stock market is going down and the Dow is collapsing, investors are seeking the haven of bonds, taking money out of the stock market, putting more money into the bond market. Traders at that point don't have to offer high yields, so the yields will come down, thus mortgage interest rates come down. So, good day on the stock market, interest rates typically go up. Bad day, interest rates usually go down as well. So, how does that impact today? Well, rates basically had been low for a long time over the last year, and part of that was because the federal government came up with a program called the Mortgage-Backed Security Purchase Program. Indeed, they were buying or committed to buy a certain number of mortgage-backed securities throughout the year to keep rates low, to keep the housing market going, to get more people out there buying or refinancing, whatever they could do. So the end of that program was coming at the end of March 31st, so that's why a lot of industry experts said, well, at the end of that, obviously the demand for those mortgage-backed securities is going to be there. Traders are going to have to increase the yield, increase rates, and there you go. So we all expected somewhere of a knee-jerk reaction where rates were at 5, jump up to about 6, and settle right around 5.5% at the end of the year. So that did come and go, but why are mortgage rates currently where they're at? Well, a lot of it has to do with the example that I gave you as to how mortgage rates go up and down when it comes to the stock market and the bond market. What economists really didn't count on when they were figuring this out was some of the recent activity that we've seen in the foreign markets, more notably in Europe and, more importantly, in Greece. These situations have made investors here in the United States more jittery and have started taking more money out of the stock market and putting it into bonds, where now our rates are as low as they have been in the last year. So that's the main reason right now where we're seeing mortgage interest rates where they're at today, lower than they have been over the course of the last year, even when that mortgage-backed security purchase program was instilled by the government. So where do we go from here? I'm not even going to begin to guess when the economy is going to recover from all this, but what I can tell you is this. We've gone back down to being able to monitor rates in more of a traditional fashion, and that is monitoring the stock market, making sure that we keep an eye on inflation, and also making sure that we keep an eye on the jobs numbers. Those are 3 key factors and 3 reports that come out on a weekly basis that give us a better understanding of how to govern or control short-term interest rates. I hope all of that made sense to you. I hope the education aspect now can give you an understanding as to why rates are where they're moving at today. If you have any questions on this, by all means, don't hesitate to call me. You can reach me at 480-650-9004, or you may email me at jose.martinez, M-A-R-T-I-N-E-Z, the number 2, @usbank.com. Thank you very much for your time, and I hope you have a fantastic weekend.